Hello and welcome to the fifth video in our series on the real business cycle model. We are now ready to let the consumer problem behind and focus on what firms are doing. So let's start. As before, let's start with some preliminaries and the three questions we should always ask. What is the firm objective? That is, in this case, maximize the present discounted value of profits. What is the firm choosing to achieve their objective? Well, labor demand in this case, both present and future, but also the firm has to choose the investment and hence the future level of capital. And then finally, what constraints do firms face? Well, the firm is constrained by the evolution of capital. Now, what we want out of this problem, and that should say the firm's problem, is the properties instead of labor supply and consumption demand, it should say the properties of the labor demand and the properties of the investment demand. Okay, that's going to be the part that the firm is going to provide for our later analysis of equilibrium. Now, the firm problem here, the objective, as we said, is to maximize the present discounted value of profits. So V is going to be that value, and we want to maximize it taking the profits that we make today, the profits that we make in the future. But just as in the consumer's problem, we're going to use the interest rate to bring to present value the profits of the firm. That's going to be the role of this 1 over 1 plus R. The firm is going to be choosing labor demand today, labor demand tomorrow, future capital, and the level of investment. Now, future capital and investment are going to be linked, as we're going to see in a moment, but in principle, these are the things that the firm is choosing. Now we're going to define what present profits are. Present profits are given by the revenues that the firm gets. The firm gets revenue by selling final goods, net of the labor cost, and net of investment. So now we take out investment because it's going to be an additional cost of the firm. Note that there is nothing saying that investment cannot be higher than present profits, so that this pie can be actually negative. We're going to be coming back to what exactly it means for pie to be negative in this model. We're going to do that later when we're talking about the decision of investment. Then future profits are going to be future revenue out of the production of future output, net of future labor cost. But then at the end of the day, the firm can liquidate the capital that's left. So there is K prime units of capital tomorrow, but that's depreciated after production. The firm can sell all that capital and transform it into additional profits that they can get. So that's going to be a liquidation. Then finally, we have capital accumulation, where capital tomorrow, well, you can use the capital that's left from today after depreciation. And then if you add investment, then you can have even more capital. Okay, so that's going to be what the problem of the firm is. What we're going to do now is we can actually replace in those definitions for the profits today and the profits tomorrow discounted with the interest rate, so that we just have a single problem with no constraints. Now in the back of our heads, we know that K prime is actually directly linked to investment. Okay, I just didn't write it inside because it gets too long, but every time you see K prime, you should actually be reading 1 minus delta K plus investment. Now, the three first order conditions shouldn't be a big surprise. We have a condition for the labor demand today, a condition for the labor demand in the future, and a condition for investment. I invite you to think about this as you move along. Now, critical here is the fact that we have to take a chain rule, because we take here the derivative with respect to future capital, but then we have to take the derivative of capital prime with respect to investment. Now, with the constraint we have, that derivative is exactly equal to 1. So this term and this term are actually going to go away. They're going to be 1. But it could be the case that the evolution of capital has a more complex form. It depends on investment in a different way. And so in those cases, that derivative is not necessarily equal to 1. So it's important for us to remember that it's actually there. Now what we're going to do next is we're going to think of these two first order conditions, the first and the second one, that are going to determine labor demand, and then think about the final condition that's going to give us investment demand. Now, these two we've seen before. They're actually the same and have the same intuition, as the conditions that we had in our math review problem when we were talking about profit maximization. In both cases, what we have is the marginal benefit from hiring more workers is the additional production. That's going to be the additional revenue you get out of producing and selling that output. And in both cases, that's going to be given by the marginal productivity of labor, whether the marginal productivity of labor today, the marginal productivity of labor tomorrow. The marginal cost is, of course, the wages that have to be paid, either wages today or wages tomorrow. Notice that in both cases, this is an intratemporal choice. It's a choice that's made by the firm today for labor today and tomorrow for labor tomorrow. The amount of labor the firm chooses in one period does not affect the amount of labor the firm chooses the second period. Okay? Now, in both cases, we can just draw these as a downward sloping curve because we know that W has to be equal optimal to the marginal product of labor, and we know that that marginal product of labor is going to be decreasing as labor increases. All right. What about investment demand? Well, this is just the same equation we had before, just without the derivative here. That's the ones that I was mentioning a moment ago. We can actually just go ahead and interpret these directly. One is the marginal cost of investment in terms of current profits. Every unit of investment you have, it's going to cost you one less unit of profits today. Okay, so that's the cost. Now, because investment pays in the future, we need to bring the payoff of investment to present value. We use 1 over 1 plus R for that. As always, that's going to give us the value of future units in terms of present units. Now, the payoff is going to come from two sources. Having more investment means having more capital. Having more capital means having more output. So these marginal product of capital tomorrow, how much additional output I get because of the additional capital I got, because of the additional investment I got, that's going to be part of the payoff I get from investment. But having more capital not only allows me to produce more, it allows me to liquidate the capital of the firm for more tomorrow. Every additional unit of investment gives me an additional unit of capital that gives me 1 minus delta additional units of capital after depreciation that I can liquidate. And so that together is going to give me the total cost. So if we get more than 1 unit of present value of profits for 1 unit of investment, that's a good deal and you should do it. Of course, the more investment there is, the lower the marginal product of capital tomorrow is, because more investment is more capital. That's going to reduce the marginal product of capital tomorrow. So at some point, it's going to be optimal to stop investing. That's the point at which the present value of the future payoff, it's going to be equal to 1. Now, we can also re-express this to get an interesting result about portfolio investment. Here, if you see, the only thing I'm doing is taking this 1 plus R to the other side. That's going to change a lot the interpretation, even though it's the same equation. The consumer who owns the firm has actually 2 options at the end of the first period. Remember, the consumer is the one that owns the firm. The firm, what it wants to do is to give the consumer the highest amount of profits possible. The reason we're maximizing the present discounted value of profits, let me just go back, this is going to be dizzying, but it's worth it. The reason that we want to maximize the present discounted value of profits is because for the consumer's problem, in the present budget constraint, it's the sum of profits today plus the present discounted value of profits tomorrow that comes in. The consumer doesn't care if you get them today or if you get them tomorrow. If you get them tomorrow, the consumer can just get in debt. If you get them today, the consumer can just save and send them to the future. So for the consumer, it doesn't matter when profits are made. It just matters how much total present value of profits there is. So going back here to the problem that this consumer is solving, it has 2 options. It can take the profits of the firm, save them in bonds. Those savings are going to pay 1 plus R tomorrow. So if you save in bonds, you for sure get 1 plus R tomorrow. Alternatively, you can invest on the firm. That investment is used to buy capital, and that capital is used to produce. This option of investment is going to pay tomorrow the marginal product of capital plus the after depreciation liquidation value of that additional capital. So how much should the consumer save in bonds versus investment? This is a portfolio choice. The portfolio has, you can save in bonds or you can invest in the firm. How much should you do in each of them? Well, the payoff of the bonds, as I said before, is constant. It's always 1 plus R. But the payoff of investment is high if K prime is low. So what the consumer should do is invest in the firm until the return of both forms of investment is equalized. Because at that point, you invest in the firm. Once the payoff of investing on the firm is equal to 1 plus R, then you should just take every additional unit and invest it directly in bonds. Now, that can mean that the consumer might want to invest a lot in the firm. Say if Z prime is very high, the consumer might want to invest a lot. So it might be that investment is higher than the value of current, these are like the profits before investment. So in that case, pi is negative. Well, that should make sense. What the consumer is doing is injecting resources into the firm. What might look like losses today, it's really the consumer saving in the firm, because saving in the firm gives a higher return than saving in bonds. So pi less than 0 doesn't mean necessarily that you're making a loss. It means that the consumer is saving in the firm rather than saving in bonds. And this is an intuition that's going to be very useful later on when we think about different forms of savings in nominal versus real bonds, in nominal bonds versus the firm, because we're going to get a sense of how consumers make portfolio decisions. Well, finally, we can just look at what this portfolio decision implies. We can cancel the ones. The net return from bonds is R. This is the net return from investment. That's going to be marginal product net of depreciation. And the demand for investment is going to thus depend on how high is the marginal return, how high is this marginal product, and the level of R. So as you invest more, you get more capital, you decrease the marginal product of capital, then you fix what the interest rate is, and that's going to give you your optimal level of investment. You accumulate capital until the net return of investment is R. Now, if R goes up, that means that returns from bonds are higher. Hence, you want to trade off less investment in the firm, less capital, and more bonds. And that's going to imply higher marginal productivity of capital. That's what's happening here. In this case, if you start in R1 and instead of making R higher, you make it lower to R2, well, now investing in bonds doesn't sound like such a great idea. It might make sense to invest more in the firm. How much more? You keep investing up until the marginal product of capital net of depreciation is equal to the new interest rate. Okay, with that, we are done with the firm. Now we only have the government left before we tackle the equilibrium problem. Thanks.